going to finally make the Toronto real estate market crash? What effects do these upcoming interest rate hikes and upcoming policy changes have on the market? Stay tuned because I'm going to do a deep dive with Ben Rabidoux from Edge Analytics on all these topics. I promise you, you'll be worth it. Good day, Toronto. Welcome to the first 2020 podcast. We got Mr. Ben Rabidoux from Edge Analytics to just kind of talk about what we're seeing after the interest rate hike from Bank or lack of interest rate hike from Bank of Canada, to talk about what is going on in the market. Ben, welcome to the show again. Thank you.
Hey, good to see you, John.
Yeah, likewise. I just want to say thank you for all the things you put out in Edge Analytics. It's nice to actually have someone who, as self-proclaimed you are for a macro ninja, to talk about the real estate space without it kind of sounding like an echo chamber, because everyone is a real estate agent who talks about this stuff,
Yeah, no, I appreciate the kind words. It's been fun getting it going, and it's been great to meet folks like yourself who are on the front lines. Good to get that intelligence from people like you, because it's funny, because the macro is one thing, right? We know what the economic data is saying. We know what's happening with the numbers in housing, but it's sometimes good to add that color of like what folks like yourself, the practitioners, are actually seeing in the industry. It's helpful.
Yeah, no, I agree the same thing, because Tim Ferriss has this thing about like you gotta red flag things and like look at it, and when you're constantly in an echo chamber, I'm just like, I just need some contrarian things that I'm looking at. I'm like, I'm bullish, but like something doesn't make sense. Someone tell me this is going to crash. Someone tell me this is going to crash. I just need a different perspective.
Good for you for looking for that stuff, because that's not an easy thing to try to find. But in fairness, I mean, it's hard not to be bullish. You've read my work. It's my perspective right now is I just don't know. I think we all agree the prices are crazy. This can't continue forever. But when you start thinking through what are the meaningful catalysts, it's really hard to see one right now. So I'm actually with you. I've been bullish, and it's like against every fiber in my being to say that. But I've been bullish for a while. I've been writing, look, these prices are going to keep squeezing higher until something changes. And I just don't see what's going to change for at least the first half of the year.
Yeah, I think I'm on the same aspect. Like, I think when I started following a lot of your work, you were actually bearish on the market. And I was like, okay, great. No, this is good. And now you flip the switch. I'm like, crap.
Well, you know what? I think you have to be true to the data. And I want to be clear. It's tricky because there's a question of like, structurally, does this end well versus is this going to end tomorrow, right? And those are two very different questions. And so my perspective is, do I think this housing boom just kind of slowly, we go from 30% year-over-year growth down to something like 2 or 3% for fews? Do I think it just ends up being really quiet and calm like that? Like, probably not. There's probably something that's a little more disruptive. And so, in terms of how it ends, I'm a little more pessimistic. But when you ask, like, do I think it's going to end in the next 3 months? Like, definitely not. I don't see that at all, right? So in that case, I guess I'm, near-term bullish. I don't know how else you can frame it.
Yeah, I think my current thesis is the same as you. I'm near-term bullish for about 3 to 6 months. Then I'm just really seeing how this provincial election, this new interest rate hikes, to call it however many they have, and these new policy change coming down to see how it's going to affect the market, right?
I think that's exactly right. I'm less interested in the provincial elections. I don't really think that's going to move the needle much. But I absolutely agree. I think what we're setting up for is a very chaotic spring market as people get a little panicked and try to front run these Bank of Canada interest rate hikes, because they are coming, right? They're definitely coming. They couldn't signal that any more clearly. From my writing, I'm not of the view that we're going to have 5 or 6 rate hikes, which some people are calling for. I think we're, more in the kind of 2 to 3, maybe 4.
Agreed.
But whatever, they're coming. And so I think as people realize that, the people who have current mortgage rate holds, who are, considering buying now, I think there's going to be some sense of urgency. And you'll see some demand pulled forward into the spring. And the big question is the back half of the year, because you're right. I do think we're going to have mortgage regulations coming in probably by the spring.
Yeah, I think so.
And you layer on a couple more interest rate hikes. I think it's a very different demand dynamic in the back half of the year. I think that's finally where we hit a bit of a pocket of demand, but still you have to frame that correctly. So let's say that you have, so, from my work, I'm always about like months of inventory is the number one metric we need to look at that predicts pricing trends out, right? And that's just a simple measure of supply and demand. So for your listeners or viewers, months of inventory is just like, I'll use a simple example. You got 100 homes for sale in a certain neighborhood and 20 of them sold in the most recent month. You would say it would take 5 months to sell that 100 based on the current flow rate.
So 100 divided by 20.
Right. So
Yeah.
you end up with 5 months of inventory. And the normal long-term average is kind of 5 to 6 months of inventory nationally. It varies by geography. So Toronto is more like 3, 4-ish long-term.
Yep.
But bottom line is, nationally we're only at about 1.7, and in Toronto you're like 0.5. And so if you know that we have to get back to 5 or 6 to be kind of a normal market, and you're at 1.7 right now, well then you can have sales fall by 30%, and you're still in an incredibly tight market, right?
Yeah.
I mean, I've done the math, and you basically need inventory to triple to balance this market. You need sales to fall by 2/3, or some combination of the two. And so if we're talking about a bit of a demand gap in the back half of the year where sales fall 25 or 30%, that alone is not going to be enough to massively disrupt this market. You need a significant build in inventory to go along with that. And that could happen, but it's probably not a 2022 story.
Yeah, I'm actually glad you went there. That chart you have, I'll post it for anyone watching this, like the scatter chart with the little quadrants. I've been showing that to a lot of clients. I'm like, look, you got to see that we're so far on the left right now with like 5 to 10% increase in January 2022, but we're at half a month's inventory. And for you to get to 5 months of inventory before there's any remotely reversal of pricing, you have to increase demand significantly or increase supply significantly or reduce demand. And this is where I think you and I have the same short-term basis. Like, I don't think we can get there in the next 3 to 6 months. Maybe when we see the mortgage, the interest rate hikes like go into the market and actually affect it, and then we see potential mortgage changes that may slow down demand and cause the price acceleration to slow down. But will it reverse? I don't think so yet.
Well, I think that's exactly right. And the two kind of go hand in hand, right? Like, if you reduce demand, then you do let supply build a little bit more. If you have the normal flow rate of new listings coming to market, but you reduce demand a little, you do sort of organically end up with the slow grind higher in inventory. But you're right. You really have to frame it in terms of magnitude, right? Yeah. We're just so far away from a balanced market. So I'm in agreement there. The only thing that I've noticed, the market can change quickly if you really shake it, right? So, I mean, I'll give you 2 examples. So one would be, 2017 in York region. They dropped the foreign buyer tax, and you went from, a month of inventory to 8 or 9 months of inventory almost immediately, right? And now that's an isolated example, but even if you look at condos in the 416, we went from, it's been quite a wild ride. People don't realize in the last year and a half, or I guess 2 years, you went from record low supply at the beginning of 2020 to record high supply in terms of condos listed for sale, like 10 months later, and now we're back down to record lows, right? Yeah. So those things can change quickly, but you need a really significant economic shock, and those are just, they're impossible to predict. And what I would say is, for the people who think that the interest rate hikes this year are the catalyst, it's possible, but I would just say that 2 interest rate hikes are probably not enough, and I don't think we're going to get more than 2 hikes in the first half of the year. I mean, we'll see, but if you tack 50 basis points onto current mortgage rates, it's just not a disaster, I don't think.
Yeah, I completely agree with you. Like, 2 interest rate hikes won't make a difference, and you really need some kind of big enough shock that kind of reduces the confidence into the market for kind of a massive increase in supply to actually make it work. And the way we're kind of being told how things are going to happen, I just can't see that shock happening. And we're probably going to have some kind of correction, and it won't be caused by interest rate. Like you said, it'll probably be some kind of external thing that we're not looking at. It has to be. I just can't see something that is projected and talked about so much that's actually caused such a big correction in the market right now.
Well, that's interesting. You frame it that way. I think you're right. Normally, when there is something disruptive that happens in a market, right? So call it a correction or a crash or whatever.
Yeah.
People look for these clean explanations after the fact, and they say, "Oh, it was this or it was that." But in when you're in the middle of it, it's really hard to isolate what it is that's causing it, and oftentimes it's just simply a sentiment change, right? And then you go looking for an explanation after the fact, right?
Sure.
And maybe that's going to be how this plays out, right? But I just want to comment on the interest rate side. So my view is, I think we're more in that kind of 2, 3, maybe 4 rate hikes this year. But the symmetry around me being wrong on this is not, it's not evenly distributed, right? It's not like there's an equal chance that there are no rate hikes versus an equal chance that there are 5 or 6. Obviously, if I'm wrong, it's going to be that I'm wrong on the under, and then we get more rate hikes than I anticipate. And what I would say is, when you think about what are the things that really concerns the Bank of Canada, one of them is inflation expectations. That's a big one, because right now the Bank of Canada has a view that a lot of the inflation that we're seeing is temporary, or they would use the term transitory.
But they retired that word already, though.
I know, but here's the thing: they're probably right. Like a lot of the issues that we're seeing are supply chain related, and you just can't really control that with interest rates. You're not going to create more microchips in Taiwan by raising interest rates at the Bank of Canada.
No.
But and this is an important point. When inflation expectations start to rise, so in other words, when consumers start to believe that that inflation will be more persistent, when inflation expectations start to rise, that can create a self-fulfilling dynamic, right? So I would use the example, right? So if we look at, so use just a silly example. Let's say you've got someone that is saving money to build a deck on their house.
Yep. And
they want to build a deck in 2 years. And so they're kind of saving money every month, and they're putting it away. If that person thinks that inflation is going to average kind of 2 or 3%, so the cost of the lumber and the cost of the labor is going to rise 2 or 3% a year, they're probably content to leave that money in the bank and just keep adding to it until they hit their target. Mm-hmm. But if now all of a sudden that person thinks that costs are going to go up 10 or 20% a year, right? Well, what's the rational thing to do? They're probably going to go, geez, I should lock in my prices today. I should pull that money out. Maybe I'll borrow off a line of credit and I'll lock in those prices and get them to do the job today. And when you multiply that across an entire economy, what you see is that when people start to fear more inflation, they actually pull their spending into today. And that has the effect of creating the inflation. And that's a really pernicious cycle, because the only way for the central bank to kind of get ahead of that is to aggressively raise interest rates until they actually create a lot of downward pressure in the economy, right? And so the reason I raise that is, if we look at what's happened with inflation expectations throughout the pandemic, they've actually been very well anchored in around that kind of 3% range, right? So if you ask people, where do you think inflation is going to be, not today, not a year from now, but 2 years from now, most people in Canada would say it's probably going to be back around 3%, right? And right through the pandemic, that's the number they've been saying. And so if you look at this chart, inflation is flat as a pancake. And so, that tells you that people believe the Bank of Canada is right. It's going to be temporary. Well, now last quarter, we all of a sudden saw it tick up to 4.5%. And it's not a tick up, that's a meaningful jump.
Really big,
yeah. And not only from households and consumers, but also you see the same dynamic from businesses. When you ask businesses, what do you expect inflation to be 2 years out? Same dynamic. You got this kind of hockey stick looking graph. And I think that dynamic is a real concern. And that tells me that, there's a chance that, if consumer expectations don't cool off, the bank may have to raise a little more aggressively. And I would say that while I think that 2 to 3 rate hikes are not going to be enough to really upend this market, 5 or 6 is a much different beast, right? If we get 6 rate hikes this year, if you flow that through to household income statements out by the time you hit mid 2023, you're at record high debt service ratios in the country, and that's not a small issue. So, right now, I think that the interest rates are not as big a deal as people think, but they have a real potential to cause some disruption if we're wrong on that.
Yeah, I agree with you completely on that sentiment, where like once we get to 5 or 6, the sentiment will change from buyers. And when you're kind of like back to the mortgage rates of pre-pandemic level, it's going to change a lot of the debt service for most buyers. And while some people may have a variable mortgage that doesn't change like on a monthly lifestyle kind of expense, right? On the renewals, we're probably going to see that hit. And I think we saw that in 2018 too, right? When the rates changed. So it will take some time, but it won't what's the best way? It's going to take a long enough time for you to kind of see it, where we can actually maybe see this slowly moving train wreck happen. But and that's just like one component of what, could cause, something to upend the market. But then if we layer different components onto it, then that's when we can see like massive disruption. And I don't know what those other things layered on are right now.
Well, I think mortgage regulations are one that we can talk about. But before we do that, I want to ask you, I'm kind of curious. So, here we are today, we're sitting at, fully discounted variable rates kind of in the 1.5, 1.6 range. Fixed rates, you're kind of more to what, 2.8, let's say, 2.8, 2.9. Yeah. So in your opinion, what's the kind of tipping point in mortgage rates where your typical client all of a sudden runs into some issues, if you don't mind me asking?
So for transparency, obviously most of our clients are investors, right? So we look at cash flows and a lot of that. And the properties we're buying right now, despite the higher price point, we're probably gonna need to see a mortgage rate of at least 2.25 before the numbers with my like baked in, kind of anti-risk kind of policy, so that like, poo-poo hits the fan, you don't have to sell, before the numbers don't work. So that'll probably be about 4 hikes. And that's—
So you're talking 2.25 on a variable?
Yeah, 2.25 to 2.5 on a variable before I feel uncomfortable, but the numbers will still work, right? So like they're still cash flow positive. But when you talk about, I would say most people who are just like saying buying condos 20% down, 30-year amortized, you're like minus $500 on a 1-bedroom right now. So when you increase it to 2.5, you're going to be like minus 7, 8. And that is a breaking point where it doesn't make sense even if you incorporate the mortgage pay down, right? Because as you increase your interest rate, your equity pay down becomes lower. And no matter how much you kind of do like, financial gymnastics to kind of make this property look like a cash flow positive by baking in equity, it just doesn't work at that point, right? So then it becomes really like a gambling situation where you're just like, all right, well, the market's got to go up. That's the only way I can make money. So I think that's kind of what I would
so you're kind of on the fence that 3 rate hikes manageable. Once you're 4 or 5, that has the risk of kind of affecting psychology among investors.
I think for my investor clients, absolutely. We have clients who say are first-time home buyers, and just the thought of one interest rate hike actually freaks them out.
Is that right?
Yeah, it does. Like people who don't have a financial grasp of what the interest rate actually looks like for them, right? So when I map it out for my clients, I'm like, hey, look, here's, a 1/4 point increase on your mortgage on $1 million mortgage, right? That's the average mortgage right now. I'm like, this is what it does to your monthly cash flow. And they're like, yeah, I can tolerate that, right? But then I show them like, look, if you're worried about how many hikes that are coming down the pipeline, you got to look out 4 hikes. So 4 times 0.25, then that starts to worry them. But then now we get into talking about, do we go fixed at that point, right? Because while talking to investors, the investors want flexibility, right? So the ability to break and refinance and re-amortize variable all day, every day. That's always recommended. Right. But when you got first-time home buyers who just want to sleep at night, right? I'm like, then you just got to go and you fix, and then nothing changes, right? And they're willing to pay that premium. So right now, most people are still going variable, because when I kind of show them the numbers, I'm like, okay, I'll just probably take the risk, because to pay a higher 1% interest going fixed just doesn't make sense. I can actually sleep easier at night knowing that I have maybe 4 rate hikes before my mortgage changes. And as you know, most banks, if you kind of want to go and get a fix, they'll give it to you just like that.
Right.
Yeah.
Right.
So that's kind of what I'm saying.
That makes sense. Okay. So 4 rate hikes. I think we're both in agreement on that. 2 or 3 manageable, 4 start to become a lot more problematic. But that's interesting around the psychology of first-time buyers, that any thought of rate hikes really freaks them out. That's one thing I do wonder is if there's going to be more, like when we look at, so some of the charts I put out where you just look at sales volumes, right? Like actual unit sales. I mean, it's just hard to imagine that we just had a record year for home sales nationally by 20% over any other year.
Absolutely crazy, just bonkers.
Right? So, I mean, yes, there's a lot of investors active in this market for sure, but it also implies there's a lot of first-time buyers that have kind of felt some, to use an industry term, some FOMO, and have jumped in. And I do wonder.
100%.
Yeah, I mean, I think the demand side is more sensitive than people probably realize. If we were sitting here today and inventory was at normal levels and sales were this insane, I'd actually be a lot more bearish, because I don't think I'm certain we can't sustain this level of demand.
Oh, no, no way. Like, but you got it. Okay, so here's just a really fun thought. Like GTA has averaged 6%, right? I know you track all of Canada, but I track like GTA. If you go 6% for like the next 10 years, we're at like a $2 million average price point, because it compounds significantly more when we're in like 7 figures. Like, this can't go on.
Yeah, I mean, I think that's probably right. I just, it's just at the end of the day, it is the intersection of supply and demand, and until we see more demand, that's one of the things I'm still wrestling with. Is like when we looked at, in COVID, when COVID first hit, new listings plunged. right? And there was just no new supply, and which made total sense because, of course, the last thing you want in the pandemic is a stranger walking through your house. So totally understood that. But new listings are still way below normal levels, right? I was sort of operating under the assumption that a lot of those new listings that didn't materialize during COVID would start to materialize as people had a little more confidence, and they just haven't. And so I've kind of got two theories on that. One is either people are still more concerned about COVID than the numbers would suggest, which I don't think is right. But the other thing I wonder is if the fact that there is so little inventory has kind of created this self-feeding dynamic where I don't want to list my home for sale until I know I can find somewhere else to move to.
Nailed it right there.
I don't want to get into a bidding war with 50 other people and I can't secure that house, so therefore I'm not going to list mine. And then it creates this feedback mechanism where nobody's listing. And so if it's the latter, well, that actually suggests that maybe as you start to see a bit of, back half of the year, you start to see sales come off, maybe a bit of inventory builds, that kind of tension eases. Maybe a lot of those people that have held off listing, maybe you will see a big jump in listings in the back half of the year. I mean, it's possible. What are your thoughts on that?
I agree, but I'll add one more point to it, right? Like I have this, again, anecdotal evidence from myself and just like some high performing realtors I kind of chit chat with. We all have listings that are ready to come out this year, but we can't find anything to buy. And I would always recommend my clients in a market like this, we got to buy something right now. Cause like I can do my job and I'll sell that property for you so fast, right? But to find you a place that you love, that you're going to transition to, right? Home you spend 5 to 10 years in, that's so much harder. And you're constantly competing. So that holds back the listing. So it is self-fulfilling. Then the second thing is when we have clients who are, say, going from a condo to, a freehold home with the rates this low, and if they've held the condo for 5 years, I run the numbers for them. Like, look, you can actually probably just rent this out, refinance your property. You'll be like, and paying an extra $400 a month in terms of like your monthly expenses, but you got to keep this condo. And while I don't think most agents would do that because, you lose one side of the buy and sell, right? But I tell my clients, I'm like, look, this is probably for your own benefit in the future, knowing where, we don't have to go there, but like too much money printing, right? I'm like, you're better off holding these assets and I'll help you with managing the tenant than to liquidate this thing right now.
That's a great point. That's the other dynamic I hear a lot of is people who would normally sell out their home and then move into another home are keeping their existing home as a rental. And you hear a lot of it. And so that's also affecting the flow of new supply. I think those kind of three main dynamics help explain. One of them maybe is a little more structural, like what you're describing there, maybe just people in a low interest rate world with solid, increase in real assets. Maybe that just keeps going. Yeah. The other stuff though, that whole dynamic of the market almost feeling frozen because people can't list to buy something else. I feel like that has the potential to you maybe see an inflection point later this year. And who knows what that's going to look like.
It actually always happens. Like I track the activity, right? In terms of like sentiment as well. And I got like big spreadsheets. So what I always find when you enter December and January with less than 1 month of inventory or like 1.5. So the stuff we saw in 2016 going to 2017, 2019 going to 2020, before the pandemic, we're actually heading there. You always see a crazy winter month. And I always make this joke with people. I'm like, how like everyone in the new year, it's like, oh, new year, new me. I'm going to get fit. I'm going to get ripped. I'm going to get jacked, right? New diet. Yeah. There's a lot of people who come like new year, new house, right? Or like new year, new investment, but nobody sells in the winter time. So the winter market, you got like, I would say maybe 2x increase in demand just when the holidays roll over. And I see this all the time because like the calls and the inquiries always ramp up. The smart ones get ahead of it and they call me before they celebrate the holidays. And
that's interesting.
Yeah. And then that always dictates where the prices go. So if you got 2x increase in demand, supply doesn't come on in the winter months, we see massive ramp ups in price. We saw that in 2017 in like a crazy way, kind of like what we're seeing right now. And what happens is spring usually has inventory coming out. So you got your regular listers, right? And your regular people who are like, you always list in spring, it's the highest price. And that's just a sentiment, right? It's just the ongoing thing that people just acknowledge. But then you also got people who kind of aren't, what's the best way, like, they're not grasping the whole money printing thing. And they're like, oh, this is the first time I can have like $300,000-$400,000 in my bank account, right? then they'll be like, well, I'm going to list right now. I'm going to sell it. I'm going to rent. And they're trying to time the market. So when I see a lot of that stuff happening, that's when I know that I actually think inventory is going to be coming, because people are incentivized by the money that and how much prices have gone up. So those are the ones who lead the listings. And then the spring guys who normally list are like, oh, person X got that. I want X plus Y. And then we see an increase in inventory. And then that's why I think we'll probably stagnate in price come like April, May, like maybe like 1 or 2% increase stagnate, like not kind of like this, 5% month over month increase. And it's always a winter month that increases like crazy. And I tell this to everybody every single year. Happens like the last 4 years.
And that's mostly a function of just the fact that inventory is always lower.
Yeah.
But if you keep demand, if you have stronger demand, then you end up with more kind of reflexive pricing.
Yeah, exactly.
That makes total sense. Let me ask you this, and sorry, this has turned into me interviewing you more, but
no, it's good. This was always just meant to be a chit chat, man. It's always just a chit chat.
Yeah, this is good. So my view. I think that regulators have signaled very strongly that whether you agree or not, they view investors as perhaps contributing to some of the fraud. Not investors per se, but the rise in investors and the increasing prevalence. I think they're signaling very strongly that they're going to tighten up mortgage lending criteria around any second property. And so let me throw a hypothetical at you. Let's say that, okay, I'll give you two different options or two different scenarios. Let's say scenario one, OSFI comes out and they say the minimum down payment on a secondary property, whether that's a rental or recreational, is now 30% instead of 20%. That's option number one, or scenario one. Scenario two is they say 30%, and they say you can't borrow the down payment off an existing property. I'm curious what your thoughts are. How would the market or how would your clients react to those two scenarios?
It's funny because I literally have a piece of paper to the left of me right now, and that was just the one question. Like, make sure ask Ben this question because I wanted to hear your take on.
You want to hear my thoughts on it?
Okay,
I mean, I've got.
Okay, you go first. Yeah. Or you want to hear my first? Whichever.
Well, okay, I'll take it first.
Okay,
first.
Go.
I think so. There's two ways to look at it, right? There's one is like, what's the mechanical impact in the sense that like, how much will it actually move the needle in terms of people's ability to get the financing? And that's relatively easy to quantify. Mm-hmm. But the much bigger issue is what does it do to the psychology, right? And like what we saw in 2017, you had this foreign buyer tax come in, and like, was it really that much of it like a big deal in the grand scheme of things? Like, probably not. But what did it do to investors' appetite in places like York Region, which had run up the most? It was a profound change, and so. I don't know. I think a policy like that would be, especially if you limited. Okay, so let me do it one at a time. If they just said 30% minimum down payment, it would sting a little. But the issue is people that are already sitting on an existing house, being able to pull more off that house is not an issue right now.
Yep,
so all it'll do is affect how much more you have to pull off the home. Yep. So not a material increase or change in demand, I don't think. But if they limited how much you could borrow off an existing property, that is a major problem, I think.
Yep. Agreed.
And I think that where that would be felt most is not so much the places like Toronto, but what I would worry about is some of the secondary markets in Ontario that have kind of become these quasi-recreational properties where, during COVID, the demand surged, everyone wanted out of the city. I mean, it's crazy to look at all these smaller metros in Ontario, and they've all outperformed even Toronto.
Oh, the Bancrofts of the world, and Tilsonburg.
Right? I mean, I'm in Owen Sound. It's crazy the places that, like the recreational properties. I mean, Sauble has gone absolutely crazy. Collingwood, right? Those places, I think you could see a York Region type effect there, where the investment demand just dries up very quickly under that sort of a scenario.
Yeah, I agree. Or if that situation where you limit the tapping of equity to buy something, the auxiliary markets will get affected like right away, probably like York Region level crash. I also agree with you that say it's a 30% down payment increase, it will be a shock, but I don't think it'll shock the market too much. Like, I think it'll probably maybe take at most a quarter of the investors out, right? And this is just speaking from my own data, knowing my
I'd be surprised
portfolio.
if it's even that high, to be honest.
Wow, I was just trying to be a little bit more bearish, but yeah, I agree. like it won't affect it too much because let me give you an example of some like the prototypical type of clients I work with. Chinese people came here, immigrate, even like anyone immigrants here. First thing to do, I want to buy a house. I need to lay roots. Bought this thing 10 years ago. Prices have doubled, right? So now their house is worth 1.6. They got $200,000 mortgage on it. Always was taught, pay down your debt. It's the smartest thing to do, right? Which makes sense back in the day, 8%, 10% interest rate. Now at 1.5 mortgage, makes no sense. More and more people are coming to me like, Zen, I'm slowly starting to grasp this inflation thing you keep harping about, right? And how real negative rates are below what they should be. So I need to get into assets. So when I look at their portfolio and analyze how we do this, I'm like, these guys got like $800,000 in equity to work with. So that's not going to affect the 30%, right?
Right.
And now when we talk about if we were to introduce the the forbidding of using existing equity to buy investment properties, that's going to kibosh all of them right off the bat, right? You need actual liquid cash that you have to earn in either your, you can't do actually, like you have to earn after tax money to make it work. And that's really difficult, right? And what I'm always concerned about if they do implement that is what is dictated as money that is refinanced or not. Because right now in the lending space, when you're trying to get a mortgage, they just want to see proof of funds for 90 days.
Right. You're right. There's going to be loopholes around it.
Exactly.
Yeah.
So when I look at this, I'm like, I'm just talking about myself personally, right? If I know, say, maybe more and more talks of investors, having a target on their back by policymakers, and I'm seeing how rates are so low right now, and they're still kind of loosey-goosey with, certain colorful banks like breaking all the, exceptions and TDS limits on your borrowing, right?
Well, hold on. Let me stop you there. What color banks are we talking about? Are these green or blue or are they red?
Yeah,
okay,
the Canadian,
okay.
yeah.
That's what I thought. Okay.
So
it's so funny. Can I just stop you there? It's so funny how everybody in the real estate community knows which banks are kind of the loosey-goosey banks, and it's always the same, really the same one in particular. But at any rate, okay, keep going.
Yeah. So wouldn't I go to a red bank and be like, all right, I'm gonna refinance these properties, let the equity sit there for 90 days, and if they don't change the way they track your proof of funds, this is not a refinance. And if there is any blood on the street because of these policy changes, I'll go buck wild, right? So this is a highly sophisticated analysis for me. And I would say, look, I got a lot of investor clients. Some are, starting one property. I got some at 10 and some at like 50, right? So the clients, who are like in corporations and they understand all this stuff, like we're all talking about inflation, how that stuff's happening. They're like, yeah, then I think you're right. Like maybe we should start mobilizing and refinancing some of this stuff. Then that's kind of where I'm like, you got people with big portfolios that are going to continue buying. This could include your corporations and, your pension fund guys, right? Who understand and can use commercial lending. And that's a topic we can jump on later too. And then you got your guys who are mom and pops who will get eliminated. And I would say maybe mom and pops are like 50% of my personal investor base. So if that rose, I think maybe we'll have a reduction in 50% of investors if we go that route.
That's interesting. I mean, I think it'll also just force a lot more volume through the less regulated channels, right? So if this comes down from OSFI, the credit unions probably won't follow, the mortgage investment corporations won't follow. So you'll still have options to buy, but the economics will change quite a bit, right?
It will. And the thing that I saw when, the economics change is when mortgage rates or like the sentiment says, hey, you know what, this FOMO is over. No one YOLOs into stuff anymore. They're like, the market's going to crash. I see a surge in rentals, and rentals always go up in price. Now, I want to separate out the rental component where I talk about rental for like housing, freehold, because I think you and I probably both agree in just reading your writing that we're going to see a surplus in like purpose-built rentals in the core. And I think we may at some point actually get a very balanced rental supply in the apartment condo space in the core.
I think that's right.
And so this is why I think if you own any freehold properties where people want to like raise a family there, that stuff is always going to be in demand. I always see rental stuff when rental prices go up at that point. But the condo prices, it's always very much seasonal, very, very seasonal. Like everyone always moves in the summer, and it's always driven, especially downtown core, by the international students.
Yeah, for sure.
Like really driven.
Yeah,
so
that's interesting. What sort of cap rates are you seeing on single family rentals in the GTA right now?
Well, if it's a single family home, it's like just absolute trash. It just barely beats inflation. It barely beats the mortgage rate. But you know,
I'm surprised you even get that. So okay, but if you're getting 1.5, so you're talking cap like sub 2%.
Yeah, sub 2
cap rates. Yeah.
Sub 2 for like multiplexes, duplex, and triplex, and okay.
Like, but for an actual single family, if you were to buy a standalone semi, single unit.
Oh yeah, like sub 1 for sure. It makes no sense to actually carry as an investor. But here's another thing to think about, right?
Does that worry you at all, by the way?
Oh, 100%. You know, when I started, we were at like 8% cap. Like I used to do a lot of commercial stuff, right? And we were looking at office buildings, like medical office building cap rates were crazy high, right? Everyone wants to get into that stuff, and your doctors stay there forever. But the cap rates getting completely compressed down really freaks me out. But if you look at it from like call it an institutional investor, right? They look at it as like, well, where else am I going to put my money right now when you got your bonds being absolutely crushed? Do you go in equities, or do you want to buy something that you can actually control, which is real estate, and it's got some leverage on it? So I think the cap rate, you know, being compressed still kind of beats out most of the other options for people who are in the where do I put my money space.
Yeah, that's interesting. Yeah, that's. I do wonder how that plays out, because if cap rates, I mean, they ultimately have to be tied to interest rates over time, right? And so if we're at if there's a chance we're at a generational bottom, like we have to recognize, okay, so what's been driving real estate prices for property in Toronto, right? You know, part of it has been, well, a big part of it's just been that you're getting these multiples expansion, because as interest rates go down, the cap rates come down, and you're basically getting the benefit of just cap rate compression. That's be the best way to put it. And so going forward, like even if the income or the rents can continue to go up, there's also the argument that as rates, if we're at a generational bottom in rates and they start going back up, then this cap rate compression is going to unwind. And even if the rental growth is still solid, you might just end up with like a lot of years of just kind of mediocre returns on the actual price. Now you're still going to get your principal repayment, and you're still going to get your rental growth, et cetera. But it's just hard to see how you get 10 or 15 or even 5% price growth in that environment if you get this slow grind higher in rates.
Yeah, and I think when the rates go higher, and let's just assume there's no yield curve control, and maybe the bonds start producing some better yields, I can see a flight of capital. I can definitely see it in the institutional guys for sure. Yeah, but like even right now, like when we're talking about cap rates, like let's just bring it back down to your mom and pop guys who are investors, right? Like they don't even like. I would say 95% of the people who are listening probably won't understand the last 10 minutes, I just talked about. We're probably just lost a bunch of people. But like when we bring it to, say, the cash flow numbers, right? Anyone who's kind of like investing for the last few years and say they're doing, a solid $1,000, $1,500 in cash flow in their portfolio, you could probably sustain a negative for a little bit, whether it be due to increased interest rates or the rents, or vacancies or rents coming down, even in the condo space. That's why, like, I find when you have price appreciation in the call it suburban area, not like suburban where you are, like suburban, you're talking about Hamilton.
905.
The 905, sure. Right? Like the core 905, not suburban 905.
Right.
I think there's going to be a lot of people who move there because when those prices go up and people get priced out, but the investors who still have properties that make a lot of money, they generally move their assets into the condo space. And that's either from their kids needing a space, and every 18, 25-year-old wants to be downtown. So we got a lot of people who are just buying these condos despite the carry being negative, right? They can sustain it. And that's kind of what propagates it. But when you have, say, layering components of, say, lots of supply and interest rates going up, I have a little bit of concern for where these condo prices are going to be, because I have a hard time justifying these rental rates going up like 6 to 8% a year, knowing how many purpose-built rentals are coming on the market soon.
Yeah, not just purpose built, but also the condos. It's interesting. Like when I look at Ontario, so you can zoom in on Toronto. There's less so we're still at a record in terms of units under construction. So if you look at like purpose built rentals, and then you also add in, call it like half of condos, because I think about half of new condo completions end up in the rental pool. It's probably a little higher, but conservatively, I'm just using half. So I just have this metric where I look at, well, what does that look like if you add purpose built rentals plus half of the condos, right? Very high in Ontario, but I'll tell you, it's not nearly as crazy as like Quebec, right? Or BC. Like there, those charts are wild. They just look like a hockey stick. I mean, we're 10x what we were a decade ago in terms of units under construction. So like, I think you're right. I've kind of made that argument for a while, that I think the people who have gotten used to the crazy rent growth that we've seen in the last, I mean, notwithstanding 2020 with COVID, but 2018, 2019, I just don't think that's going to be kind of a feature of the market going forward once all these units start to complete.
Yeah, I agree with you. But let me layer another weird complexity that I'm seeing the last 4 weeks. The amount of, I think, pull forward demand for buying a condo for young 30-year-olds, call it, is sky high right now.
They just have to get onto the property ladder.
Yeah, exactly. Yeah. I think the sentiment is there for a lot of younger people. And I was kind of preaching this to a lot of people. I'm like, I think condo prices are about to rally like crazy as a percentage to percentage, just because affordability. And I'm seeing condo prices increase by like $100,000 in the last 4 weeks on like just regular 1+1. And when we're on the list side, and when I talk to some of my other clients, you'd be surprised. It's actually not investors. It's actually end users.
I believe that.
So that's why I was like, well, like my philosophy has always been, half of the condo buyers are driven by people in the 905 who've made equity. And it's like a perpetual circle, right? Like, equity in your 905 home goes, you move into the condo space, and the condo goes up and cycles around, right? But I'm seeing 80% end users right now. And we ask everyone on the list side, and it's just mind-boggling how much that they're able to push themselves and kind of like FOMO into it, because they're just afraid they're going to be priced out. So the sentiment is like, either get in on the real estate ladder now, or you're going to be gone forever. And that's really wild. Propagating.
That's a dangerous mindset. That's kind of like when you start to see that widespread, I feel like that's very late. I mean, we've seen that for a while, to be clear. But I think we both agree that the stuff we're seeing now, we've just never seen that. Even going back to 2017, it hasn't looked like this. This level of FOMO and this level of just incredible tightness in the market. I just feel like, I don't know. I think we're getting close to something breaking, and it'll probably break after the spring selling season.
I think so too. That's why, like, when we say break, I'm like, something will break, and the acceleration in pricing has to stop. But between like 6 to 8 weeks now, like, everyone's going to go buck wild. And like the thing that I always find interesting is, when interest rates do go up, there's a counterintuitive effect of what happens to the market, because you got your first-time home buyers holding that little piece of pre-approval, and they're like, look, I got 1.5 pre-approval. And then the interest rates go like, oh my God, I better buy something now 100%. In the next 60 days before it expires. And then it just jacks up the price some more.
Yeah, I think that's that's what I said right off the top. I think we're going to see a really chaotic spring, in part because you've got people that are going to try to front run that. And then the back half of the year is, I think, it's not hard to get to a worldview where the back half of 2020 looks dramatically different than what we're going to see this spring, and what we've seen really in the last kind of 6 months, which is just this frenzied, hectic market. I think it could be a very different market in the back half, but there's a lot that has to happen. There's a lot of inventory that has to come online, and sales to slow dramatically. And so we're a long ways from that. Even if the wheels kind of fell off today, you're not into, a balanced market probably till the back half of the year at least. So I think regardless, you're going to have a crazy spring.
Do you ever worry that if everyone kind of goes and does their thing, when, knock on wood, these lockdowns are fully out, kind of like what we saw last summer, but then the sentiment doesn't change too much and we have a hectic fall? Because we saw a really crazy, like, October, November, like really crazy.
Listen, man, I'm like, I just can't discount any scenario anymore with Toronto. Who knows? I mean, it's entirely possible that this continues for another year or two. It's entirely possible. I mean, I think there's an argument to be made that based on densification trends and based on just broadly income trends that like, I think Canadians still have this mindset that everyone should have this kind of 50 by 120 lot in any city that they want, and they should have the right to own this detached property with the picket fence. And I just don't know that that's going to be the future. Like if you look at cities around the world, there's a lot of cities where that doesn't exist, right? It's high density urban living, and maybe that's what we're heading towards. And so you're just not going to see the affordability on the single family, right? In the 416 ever come back. I mean, there's a possibility that that's true, right? So I don't discount anything with Toronto. I mean, Toronto hasn't made sense to me in quite a while.
Yeah, like I thought I made sense of it, but then when I start studying it more, I'm just like, it actually doesn't make any sense. And like, regardless of, what other realtors want to say in a world-class city, like, I don't think we're good, but I don't say we're world-class, We're not quite there yet, but I think can we work our way there? Maybe.
Yeah, I think that's probably right. But at the end of the day, it's it's not just the fact that you're in Toronto; it's the fact that you're in Canada with the benefits of, the social safety net and the healthcare and the rule of law and all that stuff. And so, I think when you put all that together, you understand why it becomes appealing for investors around the world to come here. You understand why there's such a premium. I don't know that it's sustainable. I'm not going to say that it's never going to change, but I don't know that we're ever going to see the affordability levels that we saw 10 years ago come back, or 20 years ago come back in Toronto.
I don't think so. I mean, like, it's a good point when you bring up the whole Canada safety net thing, right? I know it's a topic you're passionate about, and I think we both read Sam Cooper's book, right? Like when I was in Dubai, the amount of people with oil sands money that want to just buy property and have the thoughts of immigrating to Canada is really high, right? And like they do all the legitimate way, but like we as Canadians don't ever want to immigrate or even can't get a passport to say Dubai, right? So the immigration flow is a one way into our country, and I know a lot of people are going to hate me for saying this or whatever, but like, should we just stop immigration for a little bit just so we can like get the governments to talk amongst one another and increase some housing supply and let the density kick in?
Well, now you're into an area that I've been writing about for quite a while. I think what I find most frustrating about this housing issue is that there are elements of it that are kind of like off limits, right? So in Canada, you can't even bring up any discussion around immigration reform without being labeled sort of xenophobic. It's kind of like this, like, just the sacred topic that no one's allowed to question. And I don't like that.
I get a little bit of leeway just because I'm an immigrant and I'm culturally.
You can get away with it. Right. The white guy can't, right? But no, I think you're totally right on that. But here's what I see, right? If you think about it kind of rationally, you've got the federal government that's setting immigration policy and is explicitly targeting a level of immigration, right? So 401,000 in 2021, 411,000 in 2022. And so that's their prerogative, whatever. But the actual ability to deliver that housing rests with the municipalities.
Yep.
And what we've seen is while the federal government has kind of plowed forward on hitting these immigration targets, municipalities have either been unwilling or unable to deliver the housing supply needed. And so I think it's worth having an honest discussion around immigration policy from the perspective, not even necessarily about the numbers, right? But do we need to be more thoughtful about trying to encourage new Canadians to settle in parts of the country where there is more flexible housing stock, right? Like there's ways that we can do this. Or do we need to, I think the Liberals and the Conservatives both ran on, in part, their housing platform had this idea that we need to incentivize municipalities to deliver that. So we need to tie whatever transit funding or whatever it might be to their ability to hit these internal targets for delivering housing stock, right? And so I think everything should be on the table. Like this is a real crisis, and the absolute number, like there's nothing that says that 411,000 is like the optimal number. Maybe we need to address that. Maybe we need to just talk about how we encourage people to settle outside of these core areas where we're having a hard time delivering supply. All of those things should be on the table. I 100% agree, and I find it really frustrating that there's groups of people that just want to cancel that discussion when this is a crisis. We should be able to have these tough discussions.
Yeah, I'm seeing a lot of the chats about the upzoning every single family home lot in the Toronto area. I think that's a great idea. Or
I
even
think that
just
makes a ton of sense.
it does, but I'm seeing so much like backlash. And I just talked to some people who are selling, and no one just wants any neighbors to have more density. But at the same time, they're all like, yeah, let's just let all these people in, we'll house them, we'll find a way, but just not in my neighborhood.
100%. Well, that's exactly the issue. So the people who are ultimately in charge of approving the new housing stock have to listen to their neighbor or their brother-in-law complain about the person across the street wanting to build a fourplex, right? And so they have to respond to that NIMBY attitude, right? And not in my backyard. And that's the fundamental issue with the system, where you've got the Fed setting population targets, but the municipalities having to listen to these people that don't want supply.
Yeah, and that's what we were talking earlier before we recorded. The incentive structures are all messed up in terms of how we're trying to grow the city. It just doesn't make any sense.
I 100% agree. 100% agree on that. Yeah.
So like, if that becomes a layer to what we're talking about initially, like we can't bring any single family home supply on. And then when you get to the greenbelt stuff, like that's just a topic you can't ever talk about either. So it's just kind of like, is that Batman line where like immovable objects hitting an unstoppable thing. Well, I'm butchering it, right? Whatever. But like, it just feels like that right now. I'm like, it's just two things colliding where no one's going to budge. And the kind of like chaos and the damage, the collateral damage, are just people who are just trying to find a home.
Yeah, no, that's 100% right. And something's got to give. I think that, we do need immigration. Like you look at the natural increase in Canada, we're about as low as it's ever been in terms of Canadians making new Canadians. You do need that. And one of the superpowers in Canada is that we do have the ability to attract the best and the brightest globally because of the social safety net, because of the safety and the rule of law. What I think we need to do is make damn sure that's who we're bringing here. We want to be bringing the best and the brightest who are going to improve the long-term economic fundamentals of the country. And I just sometimes sense that, we're putting too much emphasis on the absolute numbers and less emphasis on ensuring that we are getting the best bang for our buck, because the trade-off is that we have a housing issue, right? So you have this prospect for better long-term growth, but in the interim, real housing issues. And so, we need to be cognizant that that's the trade-off, and we need to make sure we're getting the best value for that policy.
No, I completely agree. We're doing more quantity than quality, right? But like one of the things that I always struggle with in terms of like someone immigrating here, where they're immigrating from, despite how crazy the, call it, housing crisis we have right now, it's not as crazy as where they immigrate from sometimes. Right?
Yeah, I agree with that. You hear that a lot. Like I talk to folks who come here. A friend of mine moved here years ago from India, and he's just like blown away by how cheap land is. He's like, you guys are crazy. And still today, he's just like, you guys are crazy. They're giving this stuff away. And he's got, a massive portfolio to his credit. He's just kind of, and his whole thing was buying like farmland at the edge of cities that are expanding. I was like, and you've been doing that for 20 years, you're sitting on a ton of money. And he was just like, this is a no-brainer. I saw this happen in India. Why wouldn't you guys be, right? So you're right. There's, I think Canadians have just been used to extreme affordability relative to other parts of the world. I don't know that it's ever going to necessarily go back to being as affordable as it was in the late 90s, early 2000s, but we have to agree that this is still a crisis. This can't keep going on the way that it is, and we need to address this part at least, right?
Yeah, we have to. Like, this is why I was saying, like, there's so many different layers, I think, to what we talked about today that can like change the market. And I don't think there's one solution that fixes all of it, but these are all just kind of like issues you and I have clearly just thought about, right? And I'm glad there's someone else who's thinking about this too, because it's like, I'm not crazy because I'm like stewing in my own room sometimes. I'm like, oh my God.
Yeah, well, I think you're right. There's no silver bullet. I've been saying it for a while. There's no one policy that's going to completely change this market, but a basket of thoughtful policies can over time move the needle. And so that's everything from, trying to figure out how to increase supply. And I think the government's kind of at least on the right track there.
I think they're talking about it now. Yeah.
They are, that's right. But then also dealing with some of the unwanted forms of demand. So whether that's a beneficial ownership registry where we kind of weed out some of it, because at the end of the day, Canada's a porous border for illicit capital. We're a far too welcoming jurisdiction, globally. and we need to weed that stuff out. So there's a basket of those types of policies that address kind of the unwanted demand, and then also try to encourage supply. And if you do that over time, then that hopefully moves the needle.
Yeah, I'm glad that we have smart thinkers like you in Canada. So maybe you can at least push your side of the things to get, all the things we talked about today going, and we can hopefully resolve some of this crisis. Hopefully.
I'm trying.
Yeah. Yeah, we're trying, man. All right, Ben, I don't want to take up too much of your time. This was always a great chat. For anyone who wants to check out some of Ben's work, especially if you're in the real estate field, mortgage broker or real estate agent, check out edgeanalytics.ca. Wonderful reports, super insightful. And I look forward to reading them actually every single month.
That's great. Well, thanks so much, man. It's always great to get together and catch up.
Yeah, we'll catch up maybe after a couple more interest rate hikes and we'll see what's going on.
That sounds good. I'd love to. Yeah, that sounds great.
All right, man. Take care. Talk soon.
All right. Thanks, man.
Bye. I hope you enjoyed that chat I had with Ben from Edge Analytics. It's interesting to see that him and I are both very bullish on the short term, in a sense that prices are going to go up while we don't want them to, but it's just all the macro trends and short-term trends are looking that way. But from the long term, we're concerned about kind of the plumbing of the system, the monetary policies, kind of the exhaustion of buyer demand and how high these prices can go. And those are systemic issues in the Toronto real estate market. So if you want to check out a lot of Ben's work, you can do so using the link on the screen. It's www.edgeanalytics.ca, where you can subscribe to his monthly reports, and they're really, really good. I look forward to reading them every single month. And if you're looking for real estate help, you can book a call with me using the link on the screen. It's www.chatwithzen.com. And until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.